My name is Jeffrey Kennedy, and welcome back to another episode of Market Academy. Now, what we're going to be doing today, and most likely again tomorrow, as you know, is we're going to focus on impulse waves, impulse wave development. And also, too, as I mentioned yesterday, and I know yesterday's video was kind of long, but what I want to do this week, next week, and also, too, in the following weeks is kind of give you a more, say, in-depth look or examination of the Elliott wave principle and really how it works. And if everything goes according to plan, I'll actually kind of build on this, say, information or this material in subsequent weeks on how I actually look at it from a trading perspective, which is totally different. Forecasting, market analytics is totally different than trading. So one of the things that I enjoyed doing when I wrote my book, Visual Guide to Elliott Wave Trading, was to simply take the next step from an analytical perspective with the wave principle and kind of evolve it and move forward with, okay, now that we understand the wave principle and its relevance and how it works and how to identify waves correctly, more importantly, how do we actually apply it from a trading perspective? So I will be doing videos on that in the weeks, hopefully days and weeks to come. So again, let's build on what we learned yesterday. We went through some of the basic rules and guidelines of impulse wave development. What I would like to do today is just spend a brief moment on, well, you can see here, actually how to count waves correctly. I think this is very, very important because if you look at these two impulse waves, we have one on the left and we have one on the right. Waves 1, 2, 3, 4, and 5. Notice there's no rule violation at all. Wave 2 does not terminate below the origin point of wave 1. Wave 3 is not the shortest impulse wave of waves 1, 3, and 5. Wave 4 does not end in the price territory of wave 1. And then we have our final fifth wave move up, and of course, no truncation here. So what you see diagrammed on the left, again, is that idealized Elliott wave version of an impulse wave. Okay, well, sometimes we can get so obsessed with the rules that or sometimes with the way I like to phrase it, sometimes we miss the forest through the trees, because if you look at the diagram on the right, we also, too, have an impulse wave that adheres to the rules and guidelines of the wave principle. Wave 2 does not terminate below the origin point of wave 1. Wave 3 is not the shortest impulse wave of waves 1, 3, and 5. And wave 4 does not end in the price territory of wave 1. So technically speaking, there's nothing wrong with the interpretation identified on the right. However, I am here to tell you today that this interpretation that you see on the right is wrong because it totally ignores the essence of the rules and the guidelines that Ralph Nelson Elliott codified and offered us. This pattern, this identification over here to the right, well, the simplest way to identify or determine if your wave count is correct is simply to go back to the book. And the book that I'm referring to, again, is The Wave Principle, written by A.J. Frost and Robert Prechter. There's no better book on the market to learn the wave principle than that book. So, but if you look at, again, the line diagrams, those idealized versions of wave formation that we spend so much time looking at, for example, this is what an impulse wave should look like. Okay, the diagram on the right is what I sometimes refer to as a clown shoe wave count, because the proportion between your wave 4 and your wave 2 is so out of proportion. It's inconceivable to me that this is an appropriate interpretation because 4 is so much larger than the wave 2. Now, the reason I'm stressing this point or stressing this fact is because I still to this day know some very veteran Elliott wave practitioners that continue to label price charts this way. This is not, again, a correct application of the wave principle because it totally ignores its essence, okay? What you see here to the left, this is correct wave counting. What you see to the right is an example of incorrect wave counting. So simply put, over here to the left, this is what you want to be doing. Over here to the right, this is what you do not want to do, okay? Very, very important. The more your wave patterns, for example, if you're looking at a price chart and you think that there's a flat going on, and in your mind you're curious or are really not confident on the identification of that flat correction, then I simply strongly encourage you to go, get a book, pull out the book, again, The Elliott Wave Principle by A.J. Frost and Robert Prechter. Go to the line diagrams that actually explain exactly what a flat correction is. Look at the rules, look at the guidelines, and if it does not look like the picture in the book, then odds are it's not a flat. It's that simple. It really, really is that simple. So again, just kind of building on yesterday's lesson on impulse waves, today's focus is how to correctly identify and count wave patterns, and more importantly, how not to count wave patterns. Okay, now we're going to follow up on a few issues that we've talked about previously. One was Intuit, ticker symbol INTU, and the other one was Microsoft, ticker symbol MSFT. Now remember, we started having a discussion about Intuit following a brief lesson on price gap analysis, because we saw the breakaway gap here, we saw the acceleration gap. Here was a small exhaustion gap. But once we began looking at the, say, substructure of the move, we basically identified this type of pattern, basically an impulse wave that was still developing. That's why we were looking for the fourth wave pullback and then further rally back to beyond the extreme of wave 3 right here in wave 5 of 5. So I just simply wanted to update you where we were within the development of this impulse wave, because what we have here are waves 1, 2, 1, 2, 3, 4, 5 of 3, and this is a contracting triangle 4. So simply put, no change. Everything is still underway. Now remember from yesterday's lesson, once we begin to exceed the wave 3 extreme at 599, the minimum requirements of a completed wave pattern impulsive structure will be in place, which means that the risk is going to be to the downside as we correct that impulsive move. How do we know that? Why do we know that? Again, we're referring back to the Elliott Wave Guideline, referring to the depth of corrective waves, which states that whenever a 5-wave move is complete, a retracement occurs that pushes prices back into the span of travel of the prior fourth wave, most often ending near its terminus. So once we do achieve, say, the Fibonacci objective here of, say, 613.64, then that basically tells you you're very mature within the progression of a 5-wave move up from, say, October, the October low here, and that we don't have much more to go. In other words, the party's almost over. Now let's take a look at another example. This was Microsoft. Now in Microsoft, we were talking about this back in, say, early November. We were looking for further rally up to a target of 388.68. So now we look at the internal substructure. And the last time we looked at the internal substructure, the idea was that we were going to pull back to the 382 retracement. Why? Well, going back to yesterday's lesson, we learned that the most common Fibonacci retracement for a fourth wave is a 382 multiple of wave 3. Okay, that came into play at 362.39. Well, we fell back to that level, and we're trying to actually eke out a new high here, but simply updating that impulsive wave count. And again, these trend lines are what I call a base channel. I will be doing lessons on the Kennedy channeling technique at some point. Simply put, when you break out of a base channel, that confirms the presence of third wave price action. Now, ideally, what we've seen here as far as this fourth wave move, this is a barrier triangle. We're going to learn about barrier triangles whenever I do the lessons on triangles, but a barrier triangle occurs whenever you have a horizontal BD trend line, as we do here. Well, this allows us to identify risk right now, short-term risk, at the extreme of wave E of 4 at 366.10. And of course, our focus is still going to be higher here up to 392.47 as we see wave 5 of 5 again to complete. Notice how this interpretation, this wave count, is very similar to the, again, idealized version of an impulse wave that we see in the book, and as you can see in my line diagrams here on the price chart. What you see in Microsoft is very similar to what occurs here. Notice that the wave count that we're using in Microsoft doesn't look anything like the diagram on the right, because again, the diagram on the right is a great example of how not to apply the wave principle. Now, as far as the short-term critical support at 366.10, the reason I say that as short-term critical support is because This movement we've seen up from 362.9 still to so far has kind of still a counter trend or corrective, feel or vibe to it. So don't be surprised if we do fall below that short-term critical support, possibly come down here, maybe run some stops on some long positions, and then see the market turn up thereafter, still targeting our 392.47, if not actually even a little bit higher, say $400 a share. So let's keep an eye on this one. Again, simply put, I believe that the advance up from the, say, late September, early October low is still a developing five-wave move, and it would look best complete with still additional strength above 384.3. This is part of the value for me that I take away from the wave principle, because once you identify these wave patterns correctly, not only does it give you a roadmap to follow moving forward, but it also gives you an idea of what to expect when these patterns are complete. For example, whenever a five-wave move is complete, you're going to correct that move. Because a diagonal is a terminating wave pattern, once it is complete, we can expect the totality of that pattern fully retraced. Counter trend moves, the zigzag, the flat, and the triangle, because they are counter trend moves, we can expect them to also be more than fully retraced once complete. Well, that's about it for me for today. I will see you tomorrow. And tomorrow I'm going to show you a technique that I call the Kennedy timeline. Don't laugh. It's just something that as technicians, we all tend to do. We like to name things after ourselves, and I'm certainly no different. But I'm going to show you a very simple technique, yet a very valuable technique on how to identify when and where wave 4 is likely to occur or terminate. Well, that's about it for me for today. As always, thank you very, very much, and I'll see you tomorrow.